Well, without further ado, we'd love to hear from you all. Questions, comments, and you can direct them to either of the speakers. Yes. And if you could also announce your name and where you're from when you address your question.
I'm from the Philippines. And, you know, I grew up with importance of fiscal consolidation. My fear is if you don't do that, you're going to go into more and more debts, and that is going to worsen the problem. Because if you don't really have the revenues, the only alternative is to incur more debt.
Right. Well, again, if you incur gross debt that's financed by the central bank and your net debt does not increase, then you have no increased debt burden. So like the case of Japan, they have over 227% of GDP debt, but the effective debt is at least 100 points less than that because the most, or 100 points of it, 100 percentage points, is owned by the central bank, and there's no net debt burden. The interest payment on the debt comes back to the government. So in countries that can do that, now the risk, of course, of doing that is countries that are in a high inflationary environment, and they can't do that. Or, as I mentioned, low and middle income countries that if they grow faster will run into a foreign exchange reserve problem. But those are the things that you have to take care of. And we're looking at a very relatively low inflationary environment in most of the world right now. And so there is room for that kind of financing. That's the short answer. I could also say that in many cases, even if they had to borrow, if the United States wanted to borrow right now at 2.4% interest, 10-year treasuries, you could have a pretty big stimulus. You could have another $800 billion, and you'd have another, 0.7% of GDP interest burden in 2020, okay? So at these kind of interest rates, if you can borrow long term like that, you still have a lot of room for stimulus in a country like the United States. Again, it depends on the country's situation, on their debt, and what they can borrow. Obviously, there are poor countries. I didn't even mention, the case of Jamaica, where it's, over 120% of GDP debt, for example, and they just had a restructuring, and they're still screwed. I mean, they can't pay that debt. Those are cases where they need to have a restructuring. So that's another story. But if you're not in that situation, there tends to be quite a lot of alternative. And that is an alternative as well, by the way, restructuring your debt so that you can let your economy grow again. To me, the only alternative that's not an alternative is shrinking an economy that's already weak or in recession. That just shouldn't be considered.
I'm sorry, aren't you worried about the inflation if the government borrows from itself?
No. I mean, we just saw the U.S. Federal Reserve borrow over $1 trillion. Inflation was negative in 2009, and it's currently 1.4% year over year. So clearly, in this kind of situation, where you have massive unemployment and excess capacity, the creation of money by the by the central bank does not lead to inflation. That's, I think, obvious.
Yeah, if I may add to what Mark said, I think you bring up a very important question. And it's, is this sort of adjustment something that is inevitable and it's a matter of when you do it? Or is it something that, if you keep stimulating, you can make outputs better? And about a year ago, we did another analytical study looking at what happens to output in the medium run after financial crises. And actually, one of the crises that we looked at was the one in the Philippines. And what we found there in the universe of all of the banking crises that we had experienced in the past is that on average, you end up with permanent output losses. So relative to a pre-crisis trend. So basically, there's a bulk of output that gets lost. Now, if you think that, and one of the reasons is that you may have had a boom, an unsustainable boom or a bubble prior to the crisis. So the adjustment that you were seeing was more or less inevitable. Now, what would this mean for the level of debt? Well, if there is output which is lost forever, that means that while they're going to be revenues, they're never going to come back. And you have the choice of, what type of adjustment path you're going to take to those lower levels of revenue. But, making small changes here or there may not make a big difference. And in this context, I think it's important to also think of the experience of the Baltic republics in the recent crisis. Mark mentioned the decrease in the output collapse in Latvia in 2009 of 18%. And if you look at Estonia or Lithuania, the two other countries that, by the way, did not have IMF programs, there the output losses in that year were 15%, 16%. But what's more interesting is to see what happened prior to the crisis. Latvia was growing every year in the period between 2005 to 2007 by 11% every year. So, and I think we as well as others had drawn attention to this, and there was the type of boom, unsustainable boom, that was happening there. So unlike the other Baltics, which were growing at lower rates. So the more you go up, the more of a bubble you have, the more of a boom you have, then the more you fall. And you could say it's because of fiscal policy, but frankly, I think it's a lot more complex than that. And it's the sort of adjustment, at least part of it, should happen. Now, you can cushion it and try to make it better in order to mitigate the impact on certain parts of the society. But at the end of the day, unfortunately, when you have an unsustainable situation that has to be corrected, that has to happen one way or another. Otherwise, it's basically, we end up in a situation that you mentioned. You just end up accumulating more and more debt.
Can we have a little back and forth on that with you? I think that you raised some important issues. I mean, we, of course, unlike the IMF, which missed both of the two biggest asset bubbles in the history of the world in their World Economic Outlook, we actually analyzed both of them well in advance of the crash. And so we're very sensitive to the idea that unsustainable bubble growth leads to recessions. I have no disagreement with that. And my colleague Dean Baker was projecting already in 2002, had explained the housing bubble in the United States and predicted that it would lead to a serious recession, as he had done prior with the stock market bubble of the late 90s. The question is, what do you do when that happens? I mean, certainly it would have been better to prevent it. But when it happens, you are not necessarily, there are always alternatives. Once the bubble bursts, that does not mean that you have to consolidate in a way, for example, in the Baltics, that protects the creditors, okay, in that bubble, which are mostly foreign banks, in the case of Latvia, for example. And in the other Baltics, yeah, they have the similar output declines because they pursued the same policy of preserving the exchange rate and protecting the creditors, as opposed to opting for economic growth. I mean, even if you have, in Argentina, you had a complete collapse of the banking system in 2002, okay? And they had a very analogous situation to Latvia. Unsustainable growth, overvalued exchange rate, collapsed, okay? What happened to their economy? It declined for 1 quarter after the devaluation. 1 quarter, not 2.5 to going on 3 years. 1 quarter. And then it grew at a rate immediately after that of 63% cumulatively over 6 years. Okay, so they had their unsustainable growth, their unsustainable exchange rate. They had their collapse, and then they immediately embarked on a policy that would get their economy back to where it was in 3 years, not 10, as these economies are projected by the WEO to reach their pre-bubble, their pre-crisis growth. So there are always alternatives to policy. In the case of Argentina, they had to default to a lot of foreign creditors. Well, that's better than putting your economy through the ringer for a decade and having 20% unemployment, which is what they had during the recession. So that's why I understand your point that bubble growth leads to recession, for me, it does not follow from there that you have to take that punishment indefinitely rather than getting yourself on a sustained growth path as fast as possible.
I want to get Petya, did you want to respond at all?
Just a small point. I'm just enjoying this a lot. So
Okay.
let me just mention
Me too.
something. One thing that I think we should keep in mind is the national pride and what the authorities want in these situations. And this brings me to the issue of the Baltics and the currency boards and the fixed exchange rates. Actually, the same in my home country, Bulgaria, the currency board there. It's the authorities who wanted to preserve the regime and the currency the currency regime. I'm talking now about Latvia. So when you have this sort of situation, and this is clear, the preference is so clear because they want to be part of the they are part of the European Union. Their objective is eventually to become part of the Eurozone. And when you have that objective in mind, and their clear preferences for the first best outcome is to keep the exchange rate, then we have to look at what are the other policies that are consistent with that preference. And unfortunately, as Mark alluded in his presentation, the only alternative, if you cannot do a depreciation or devaluation through your exchange rate, you have to do an internal devaluation. And to get the internal devaluation, you end up with this very painful adjustment, which is needed to get there.
If I can just say one response to that, I agree that the authorities in Latvia, I was there last year, or was it this year? It was this year. And I saw that. I mean, I met with the government. And however, and here I would blame the European authorities more than the IMF, because the IMF is just doing what the European authorities want. There are a lot of indications the IMF saw that keeping the peg and going through this internal devaluation was going to be a disaster. But they signed off on it, and they put up billions of dollars, and so did the European authorities. And so they have to take some of the responsibility for that, because neither the fund the European authorities told the fund what to do. So if you want to put the blame there, okay, put it there. They signed off on it, and they have to take responsibility for it, because they're not going to give a country that kind of money to do something that they think is totally wrong. Like if they wanted to, renationalize their industries, for example, they wouldn't get a loan from the IMF or the European Commission, okay? So I like that argument. It's the best one you can make. It's a sovereign country, and we're just helping them do what they want. But the fact is, they don't do that when they don't like it. And so it only goes so far.
I think you were the first question I saw.
Gern Schick, I'm a member of Parliament from Germany for the Green Party. And I'm not really convinced on both decisions. Because the distributional picture is missing. In Greece, for example, it's not only about consolidation. I think it's very important in Greece. Because there is a lack of a revenue service. They always not collect taxes from the rich people on property. And there are privileges in the public sector that lead to a malfunctioning of the whole public sector. And if you don't consolidate, and if you just keep on going debt financing a wrong public structure, I don't think that will lead to anywhere. So you need to consolidate, but the question is, who pays? And the interesting thing is you need a certain internal devaluation in order to gain competitivity for Greek products within the Eurozone, and that will be a heavy burden on the workforce. But then the fiscal consolidation has to be on the rich part of the country. And there is where I don't understand the policy of the IMF. You want to stimulate the economy with internal demand. Well, when you do that and you cut entitlements and you cut for the poorer part of the population, you will not have internal demand. So the question that I want to ask is, how does it, your position relate to the distributional factor? Is it not important to redistribute wealth in the countries in order to stimulate demand, and in order to have a path of consolidation that is viable for the country and includes both fiscal consolidation and a certain way out of the crisis by stimulating internal demand?
Sean, if you want to take that first.
Go ahead.
Go ahead. Sure.
No, you're definitely bringing up an important point there, which is the distributional aspect. And I must admit, I'm not an expert on the Greek program, but from what I recall, there were elements of the program which were designed to protect the impact, to kind of shield the impact on the poor segments of the society. Now, the part when I talked about entitlements more generally, I think what I had in mind there was just the fact that in many countries, including Greece, as far as I know, the retirement age at which people can take is fairly low. I mean, I'm actually thinking now of my own country, Bulgaria, where my uncle retired a couple of years ago at the age of 55. I mean, I think that's just ridiculous when you have other countries in Europe where the retirement age is at least 10 years higher. So it's those sorts of reforms, especially in the public sector, where in some countries you have really low retirement age, is something that I think it's in the spirit of fairness, and it's something that can also help fiscal finances over the medium run.
Well, yeah, just a quick answer. I mean, I think that obviously there's a lot of rich people who don't pay taxes in Greece. You know, you have doctors making 120,000 euros and reporting 20,000. You have so those are reforms that have to be done. But the main priority should be the first. Make sure the economy is growing. Maybe you could call it a question of sequencing. What do you do first? I would say first you make sure the economy grows, and then you phase in those things over time. I mean, look at the United States. We're not going to have any tax increases, for a while. There was even the big fight over, letting the tax cuts expire and how much and all that, and it's still going on. So the idea is that you don't have that kind of fiscal consolidation during a recession. And you don't have to. I mean, they're being pushed deeper into recession. It's going to shrink. Economy's going to shrink 4% this year, right? And when this crisis started, it wasn't barely even contracting at all. And so this does not make sense. Why? The Eurozone has $1 trillion fund now. How much would it take of that to make sure that Greece, can continue to grow and then make those changes after the necessary fiscal changes after the economy is growing? And some of them aren't that necessary, by the way. I mean, you can argue about retirement age. I don't know the retirement age in Greece. We have this debate here too, of course. And but a lot of what you're seeing in Greece and Spain, the labor market reforms, for example, the privatizations, those are the European authorities taking advantage of the situation to do things that are politically unpopular and wrong, in my opinion. And that's what they're doing in the name of, restructuring the economy.
Other questions? Quite a few people have
Mark Harrison from the Methodist Church. I guess this discussion always reminds me why economics is considered a dismal science. But anyway, here's my set of questions. To Mark, the U.S. is a discussion of you borrowing from yourself like Japan does. The United States is not just borrowing from itself, but it's also borrowing money from the rest of the world, and particularly Japan and China. All right. So I don't know how that fits into your analysis. That's the first question. been this view is economies would grow, you'll have more technology and so forth, and you will be able to retire and live well. And the idea that you are to work forever, it seems, is what you kind of say. You know, like when France went from retiring at 65 back to 60, and now they're talking about 62, there was also this thought that with all this technology of a country like the United States, all the work that people do in this country, we should be able to retire. But it doesn't have to be, keep extending it. You know, and that was true for the rest of the world. And that probably sounds what I call polyandrous today. You know, we're asking people to work forever. You spend 18 years in school, then you go to graduate school, you get to go to graduate school. Then you want people to work 40, 50 years and so forth. I mean, that's what I'm trying to get at here. Right? Where is, after all this technology, this development, this resources of the world, can you retire and live a graceful life and not work a long time? What's wrong with retiring at 60? Is it really that bad? Should we want that?
You know, on the retirement, I couldn't agree more. I mean, I think that, you know, we just did a paper actually, which you can see on our website, looking at how many Americans have jobs where they just can't be expected to work longer than 65. You know, they're too physically demanding, and it's huge. And you know, that's not being taken into account in this debate here. We've already raised the retirement from 65 to 67, and you know, it's just people don't look at the actual arithmetic. Okay, I mean, we're going to be, you know, in the United States because of what you just mentioned. You know, you call it technology, but basically we're talking about productivity. Okay, because of productivity. If you look at the Social Security trustees' projections 30 years out, we have enormously higher living standards. And yeah, people can and will, if you give people the choice instead of trying to ram it through with this, you know, some kind of commission and kind of fool people into thinking there's some kind of crisis with the Social Security system, they will probably choose to pay a very small fraction of their higher income further on to spend more years of their longer life in retirement, as we have done consistently. You know, when we raised the payroll tax in the 70s and the 80s and the 50s and the 60s, okay, and nobody complained, all right? And those were bigger tax increases than we're going to need for the whole 75-year period going forward. So it is true. And now, again, there may be particular countries where it's, you know, their retirement age is too low and not affordable. But I can tell you that it's certainly not the case in the United States. It's nowhere near the case in the United States. And yet you have at least half this country convinced that it is because of what the really slanted story that we get. So the second thing is on the foreign borrowing. Now, it is true that we have increased foreign borrowing. I don't want to spend too much time on this, but the first and simple answer to the question is the solution that I suggested, financing further stimulus through borrowing by the central bank, is a way of avoiding further foreign borrowing because we're borrowing from ourselves. So it's a solution to the problem of the public debt being increasingly a foreign public debt. Okay, that's number one. Number two, which I won't have time to explain here, but it's kind of basic, also basic national income accounting, is that the reason we have increased foreign borrowing in our national, in our public debt, is the same reason we've increased foreign borrowing in our private debt. In other words, it's because the dollar has been and remains overvalued, and we're running a trade and current account deficit, you know, for decades. So even if you balanced the budget of the United States and had no more borrowing at all, you would still accumulate private foreign debt instead of public foreign debt, because the foreign part of it is a result of the imbalance that Petya was talking about when she was talking about correcting external balances in the world economy. It's the imbalance in our exchange rate that leads us to do foreign borrowing at both the public and the private level. So that's not a result of deficit spending. That's a result of an overvalued currency and foreign borrowing that leads to foreign borrowing generally.
Just to pick up your second question on retirement, I think, look, if you ask me personally, I'm going to work forever, but I understand that different people have different preferences in this respect. The point is simple. People now live much longer than they did 20 years ago. And yes, you go to school, and then you go to graduate school or not, and then you start working. But then the reality of it is that if you retire at 60 and if you live until 80 or 85, you have a lot more time. And at the end of the day, unless you have much higher productivity, as you mentioned, and these improvements in the economy that are going to afford you this time, then you don't really have many other options. So, in a way, I think it's a consistent view to at least think that the retirement age should be linked, the statutory retirement age should be linked to improvements in life expectancy. I take Mark's point, by the way, that this is actually a lot more of an issue in many European countries than it is in the U.S. In the U.S., I think it's the health spending that I also mentioned when I was talking earlier, that is the big issue. But again, if you look at the projections for productivity that we have in the U.S., in many other countries, we don't really see these huge improvements that would afford that would allow for people, for output to kind of keep expanding without having the kind of more input in terms of people working longer and increasing output that way.
Well, if I could could I just have one short thing, because I think that would be a good thing for the IMF to look at if they did. Because I know that if you look at the United States, it's very clear. We can afford our retirement age indefinitely with very little money, even as life expectancy increases. I mean, that you can just look at the CBO and the Social Security trustees' projection. But it would be good to see if there are countries, because I haven't seen that anywhere, where you can look at a country in Europe, say Western Europe. Anyway, is a result of the collapse of this real estate bubble, mostly. And so it is. That's why we see a very weak economy going forward. I mean, obviously, construction itself is a big part of it. But the wealth effect and the fact that people have lost, many people have lost most of their retirement savings, is going to, they're going to have to save some money for retirement. A lot of them have counted on their homes, and of course, you add these projected high levels of unemployment. It is really hard to see how this economy has a sustained recovery. So it's huge. In terms of solutions, the solution that we proposed was that people underwater on their mortgages be allowed to stay in their homes as renters for some extended period of time, with the rent adjusted on the basis of the market value of the house as opposed to the value that they originally were bought for. And so this would at least provide some stability for neighborhoods, for people who are and it's something that doesn't require any support from the government either. So this would be a way of forcing the banks to absorb some of these losses in the bubble inflated homes. We don't think there's an advantage to providing federal support to keep people in homes where they have no equity and no chance of getting any equity, just so they can have a foreclosure later, and the banks basically get a subsidy. So that's what we've proposed. There is some, there have been bills introduced in Congress around that.
In terms of the recovery after financial crisis, as you mentioned, we've done quite a lot of research on this, and this is why I started my presentation by saying that we were not surprised that the recovery was sluggish and it's fragile. This is pretty much what we've seen. And the aspect that you brought up is of course a very important one, what's happening in the housing market. If you look at our current world economic outlook, you'll see that one of the main downside risks that we highlight is the one stemming from the U.S. housing market. So we're clearly worried about it in terms of if that risk were to materialize, the implications it would have on economic activity, and through the wealth effect that Mark talked about, but also through the its impact on labor mobility, which is something that you mentioned. In terms of what one can do about it, I think a lot of things have already been tried, but the problem is still out there. My understanding is that recently there's been some pickup, or at least some more activity in terms of interest on the side of the banks, in terms of restructuring some of the mortgages, and so some movement there, but it's clearly not enough in terms of when you look at the number of underwater mortgages that you have there. In terms of policy recommendations, I think our U.S. team is of the view that in 2011, if there were the need for additional or for reorienting the spending, it should go in the direction to increase this labor mobility. Unfortunately, I cannot go into specifics just because I must admit I do not know exactly what they have in mind. I'm not an expert on the U.S., but I do know that it's clearly an area that we are worried about and we're thinking about.
Other questions? I know there's a gentleman in the back.
Yeah. Why the boom and bust? I mean, you're talking about growing economy or growing out of the bust. Why do we have to have boom and bust going in? How come they can't be managed? Take the last and cigarette. What happened before that? They got rid of it. And it's no accident about what happened. It happened in the 20s and 30s. They got rid of it. It happened again going in the 90s and the 2000s. So why the cyclical boom and bust? How come there can't be a managed process or managed economy where you take some of the leverage of the risk out of what's allowed for these people to take? I mean, the risk and the amount of leverage are enormous. All the numbers that have been kicked around represent that, but I don't hear any remedy going to the fact that these people have to be regulated, or there has to be some type of management in place to deal with it. What do you think of that?
Well, we have been speaking to that for the last 10 years a lot, and as I said, my colleague Dean Baker has written a lot about first the stock market bubble, and then the housing bubble. And when the IMF talks about, and maybe you can address it, but when they talk about systemic risk and having to do something about systemic risk, I mean, what better example of is there of systemic risk than an $8 or $10 trillion bubble?
Why does it continue?
Well, we haven't had the next one yet, but I mean, it continues. I mean, in our opinion, and you can see this, it happened because the people who were supposed to be in charge were asleep at the wheel. I mean, including Ben Bernanke and Alan Greenspan. I mean, they should have been able to see what we saw. They have a lot more staff, economists, and you could see this. It wasn't rocket science. When you have a 100-year trend of home prices being basically flat, adjusted for inflation, and all of a sudden it goes like that. I mean, but they didn't do it, and so I think that's where the real responsibility lies. All the officials who just rode along with and who were in charge of keeping an eye on the economy. That's not to say they should have necessarily raised the interest rates, but here's a case where they could have probably stopped the housing bubble at a relatively early stage just by informing people, right? If they had just got up there, they have a big megaphone. When Greenspan spoke, people would listen. He could move markets. He just showed them a graph and said, if you're buying a home right now in any of these bubble areas, you're basically buying into the NASDAQ in 1999, And this was very easy to show. And why didn't he do that? That's the question, but, that's the problem.
Yes, I think that's a wonderful question. There's a great book by Kindleberger. You may have seen it. It's basically the history of bubbles throughout, the first one is the tulip prices in Holland. And I love that book. And one thing that you learn is that bubbles always have a way of evolving, and it's always a slightly different bubble. We had the equity price bubble in the late 90s. Then we had the housing one here, but I think the part that was also difficult to at least predict was its impact on the financial system in terms of how it spread throughout the world. So, and the other principle I remember from the book was that the more people try to convince you that there is no bubble, that is a very good indication that there is a bubble. But just to be serious here for a second, I think what we've learned from this crisis and from this bubble is the importance of financial regulation. If we don't use that lesson to change things in that direction over the coming years. Of course, the biggest momentum for change comes right after the crisis. And it would be important to which is something we also emphasize in our report, that this is an area which we really cannot afford not to make further progress on, including on cross-border, on what's happening with cross-border institutions, how you regulate those, how you think about these macro-financial linkages and such. It's a complex field, and I think it's fair to say that we as a profession, economics, we didn't really have all of the models to be even that were well suited to think about these problems. But again, this is something that we do have to resolve going forward. And of course, the next bubble will be a different one. Mm-hmm. I can bet on that. Mm-hmm.
I want to just bring it back to our earlier discussion because it seems like that the panelists share a lot of analysis about where things are at, and that a lot of the root of the differences between CEPR and the IMS perspective come about from the policy recommendations. And I don't know if you all want to ask any questions of each other as well, because I think that's when some of the differences in perspectives came out a little bit. If either of you wanted to ask questions, to give you the chance.
Well, yeah, I am curious of why the fund hasn't, when they talk about systemic risk, why wouldn't they say something about bubbles, since we've had now 2 recessions in the United States and 1 world recession that were caused by the bursting of a huge asset bubble. So why wouldn't the fund try to analyze that a little more and pose that as a problem of systemic risk aside from, bank capital adequacy ratios and the other things that it is looking at?
This is actually one area which I could more broadly characterize as understanding the linkages and the interaction between the financial side and the macroeconomic side. And this is definitely one area where we've stepped up work over the last couple of years. And there are a number of projects going on right now at the fund. as a minor contribution, about a year ago, we actually had a chapter in the World Economic Outlook looking at the implications of having these asset price booms and such on monetary policy, what monetary policy can do. But I mean, I think you're bringing up a much broader question. All I can say is that I think this is definitely a very good topic, very important topic, and we are doing work on this. Yes, I'm wondering, in terms of your recommendation for, the way I understood your presentation is that you're arguing for, instead of fiscal consolidation, a fiscal loosening in some of the crisis countries. So I'm a little bit unsure how to take that when I think about why some of these countries are undertaking consolidation. In many cases, it's just they cannot even place their government bonds with anybody. Nobody's willing to take them. So, and you have bond rates. I mean, you have government bond rates in Greece that are, you know, multiples of the ones that are in the U.S. So, how do you solve? I mean, what exactly do you propose? Also keeping in mind the constraint that the ECB is prohibited by law, if I remember correctly, to actually do the type of financing which you mentioned in your presentation.
Well, I'm not sure if they really are prohibited. I mean, they have gotten around that, you know, in the last year or so by buying various government's bonds in the secondary market. So, and if they are, I think they would need to change that law. But I think it's a terrible constraint. I mean, it's very much as if, you know, in the United States we can in fact do it. We're not doing it. We're doing the quantitative easing, and as you said, that has a limit, right? Because what difference does it make if we drive Treasury down to 2.2 instead of 2.4? But we do have the capacity here to use, to do central bank financing, and we've done some of it actually, of government spending and a fiscal stimulus. And to say the Eurozone can't do this when their inflation is even lower than ours, and there's no risk of adding inflation, I think is a kind of a really terrible dogma in a way. So that would have to be changed. And in terms of Greece, sure, Greece has, you know, is paying over 11% for its borrowing now because the markets see their debt as unsustainable no matter what happens, even if they consolidate everything, because the consolidation could easily make it worse. You see the markets react like that all the time. You know, Greece or Spain will take the measures that are being demanded of them, and then UBS or someone will project that that means that they're going to shrink even more, and so their deficit to GDP ratio ends up looking worse for the future. So the markets are quite schizophrenic about what they will what satisfies them. But clearly, what would satisfy them is if, you know, the European authorities use the money that they have available for even Spain. You know, what is their whole debt they had to roll over there this year was 61 billion. So what is that out of $1 trillion fund? They could have financed that at zero interest, for example, and allowed Spain to pursue a fiscal stimulus, even, you know, under without looking at the alternative of central bank financing. So those are the kind of alternatives that I think are feasible. And what they're doing instead is they're trying to make them, you know, as we discussed, do this consolidation at a time when it's shrinking their economies.
Is there one last question?
This is sort of a technical question, but you know, in the early part of the decade, to come back to the mortgage issue and asset prices and inflation, measuring inflation, there was a lively debate. It was asked by a congressman to look into discussion within the Fed about whether home price rises were inflationary. And it was a very lively debate, and there seemed to be a huge amount of pressure to say, no, they're not. And Mr. Greenspan, I think, has been much clearer, and to be fair to him, he welcomed the rise in the prices because of the wealth effect, which you introduced into public discourse and said this is a good thing. And in retrospect, he says, I wasn't wrong about that. I was just wrong that the industry itself could police itself. And I thought that sophisticated investors would manage this better. But now we have a situation where those asset prices, at least the home side, significantly depreciated. And wouldn't it be fair to say that they should have been counted into the overall view of inflation or deflation? And that if you factor home price losses, wealth effects from that as deflationary, maybe we're in a much more deflationary situation than we imagine, or than we're reporting and talking about. Is there any discussion of this?
Yeah, actually, I must also use, in responding to your question, also refer to something that you brought up earlier. We're actually a lot more worried about deflationary risks. This is something that I hope is going to come out that is clear from reading our report, and especially in advanced economies, in the U.S., for example. And part of that is precisely because of these sort of effects through asset prices that will take a while to unwind, especially if you're worried of further adjustment in the housing market. That is another source of risk, downside risk for inflation. So my short answer is yes, we are worried about this.
I'm sorry, because you came up here a moment earlier. Now we actually need to close. I'm sorry, Skipper, you can come up and ask afterwards, if that's okay. I just wanted to ask if either of our speakers wanted to have final comments, because the room on the outside is getting a little bit noisier, and I think we only have about a minute or two left if you guys want to make some final comments.
Well, for just 1 minute, I would say one thing I didn't get to address and was brought up was this idea that because, like the Reinhardt and Rogoff book, for example, points out, because financial crises typically have in the past led to prolonged periods of lost output and high unemployment more than other kinds of recessions that were caused by other causes. A lot of people have drawn the conclusion that this is just our inevitable fate. And I really don't agree with that at all. I would say that those crises were followed by bad policy, and therefore we don't have to have going forward, just because this recession was caused by partly caused by an enormous financial crisis. Actually, the truth is the main cause was the bursting of the real estate bubble in the United States. So even if the financial system were functioning perfectly, we still would have had the worst recession since the Great Depression. And that's something a lot of people don't realize. But my point is just that we can't use that past as our guide. There are, as I outlined today, there are many alternatives, and they're different in every country, but there are plenty of feasible alternatives to restore full employment much faster, vastly faster than the current projections are indicating. And that's what we should be looking for. Thanks.
And I think it's great if we can actually end on a note of agreement here. This is what Mark just said is exactly the point that we also made last year in the October 2009 World Economic Outlook, in a chapter that looked at output losses in different banking crises. And one of the lessons was that a lot of things could happen. And in some of the cases, you don't actually have those losses. And what matters is the initial conditions and the type of policies that were implemented in the period following the crisis. But if we just, again, step back a little bit and think about the current situation, the recovery going forward, I think what's important is not just what happens to fiscal policy. That is one of the many aspects of the policies going forward. What's really important is to get these two rebalancing acts completed, or to get them going as fast as possible. Because without the external rebalancing, if emerging economies don't boost their domestic growth, and if they don't grow sufficiently fast, that is going to make it's much more difficult for advanced economies to go ahead and do their fiscal consolidation. On the other hand, if advanced economies don't run into big trouble in terms of implementing their reforms and their growth rate is very low, that is of course going to affect emerging markets. So what's really needed going forward is a type of policies that it's very hard to characterize and to put in a nice box and say it's this. In many cases, different countries have to do different things. And only if they all do them together, then we could expect the type of recovery that we all want to see, which is a strong one and a sustainable one and a balanced one, rather than the type of recovery we're seeing now. Thank you.
I'd very much like to thank Petya, Koeva, Brooks for being here with us today and the IMF for this debate. On behalf of CEPR, you know, we have been for a long time very critical of many IMF policies, and I think for us it's actually really important to sit in a room together and have a real debate about the issues. We're talking about, you know, the biggest possible scenario of what's going to happen with macroeconomic policy going forward, and we think it's important just to hear these views right next to each other so that people like you and the rest of the folks who will be able to see this video of this on our website in the future can make these decisions for themselves about how to move forward. So we thank you very much, and thank you to Mark, and thank you all for coming today.